Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Today, our guest is Sean Warrington, Head of Private Investments at the wealth management firm Gresham Partners. Gresham manages or advises about $9 billion for roughly 120 families across the U.S. Sean cut his teeth in private markets and corporate finance over 9 years at the Alfred I. DuPont Charitable Trust and a couple years at Lockheed Martin as well. Sean shares with us his unique process for identifying top managers, how to be a value user-friendly LP, looking forward to hearing that, and where he's actively deploying capital today. With that, Sean, it's great to have you on Swimming with Allocators.
Thanks. Happy to be here with you both. Excited.
So we like to always start out with origin stories. So kind of tell us how you made your way to becoming an allocator.
Yeah, I think like most origin stories, a little bit of preparation and a little bit of luck. I was at Lockheed for several years. I think pretty quickly into that role, recognized investing, had been a passion as I was a child, and recognized I really wanted to find a full-time job around investing. So went through the path to CFA, did an MBA. So I was ready for a role in investing. Where I got lucky was getting introduced to DuPont. I didn't know what endowment was other than the fact universities had them. I certainly wasn't aware how they were deployed. Unfortunately, I had a really great interviewer out of the gate, a person who ended up hiring me, but he recommended reading David Swenson's book on the first interview. So fortunately, by the second interview, I at least knew what I was signing up to potentially. But long story short, did get the role. But I think I got lucky in two ways. One is getting the job, but more importantly, as an LP, I think it's very much an apprenticeship business, and to be around great people really played a big role. And to frankly have a portfolio behind me at DuPont that showed me what great looks like, that was all lucky, because getting the job was great. I think being at an institution of that quality really helped me become who I am today.
That makes me curious if you have any other reading list suggestions. If people are looking to invest more as professional LPs, if there's anything else that comes to mind, whether it's a newsletter.
This is going to sound too self-serving for you folks, but I actually think podcasts are the route now. There's just so many I really mean that. Information is just freely available today. I think in my seat, that's what I do today, is hear what other people think. And I think people like to share, and strategies are tough to mimic in general, so people can be pretty open about it. That's my suggestion. It's listen to things like this.
Yeah. Were there any learning moments or stories you can share from DuPont of things that have impacted how you think today?
The one that stands out, coincidentally, is my first deal. But I think what made it really impactful, this was a manager that was spinning out of another entity in the venture space. And I think it was pretty quickly to the group of us that there was something special here. They were walking away from big time carry dollars. They had the quiet confidence that we really like to see. They just knew what they did. They owned it. And I was given an opportunity to run it down. And this is my first deal. I'm excited. So I ran really fast, built conviction with the help of the team. But I think the big learning was, you're never alone on these special managers. Other LPs were around the table as well. And it pushed this manager to end up closing the fund, which started off a month early. Then it went to 2 months early. And the fortunate part of that was it ended up being too fast for a lot of other folks. And we were able to get a really nice ticket into a fund that ultimately became probably one of the better investments as a fund type business over the last decade. And the learning for me was really the conviction. You have to build your own conviction and work things. And you want to work them fast, and you have to be aggressive, because it's not just finding the right manager, it's also getting the allocation. And I was lucky to learn that early, and it's something that has really informed the process that we deploy today. So I put that one out there.
That's a great story. And that also, can speak to what you look for in managers and conviction. So this came from another conversation, actually, that we weren't recording for some reason, but I'm going to ask you, what does conviction look like for you as an allocator, as well as what you look for fund managers?
Yeah, I think it's the ultimate question. This will sound right out of the gate, but at the end of the day, we're looking for a really competitive edge, and I'll go into what that means. But in our world, we think there's maybe 4 things that venture capitalists need to do really well. They need to source deals, they need to pick deals, win the deal, and add value. That's all obvious. But as an LP, we have to think about, where can we actually grade people? Like, where do we have an edge on understanding this manager? So we think sourcing is probably the single most important thing for us to understand. We can look at the networks that people have been involved in, the people around them. Essentially, what is their unique edge where they're just going to run into really great deal flow? We want to see that. The next question we ask ourselves, and we think we can grade this one really well too, is what is their right to win the check size that they want to deploy? And what I mean by that, and this is actually where we bring in adding value. If someone's writing a 250 to 500K pre-seed to seed check, that's a collaborative investment. You can be around the table with a bunch of other smart people and not really get pushed out. And you don't really have to do a lot to earn that check. But let's say that same person in that same round wants to write $1 million to $1.5 million. That is a much different or much bigger ask for the founder. And we think you need to bring a lot more to the table around adding value, supporting the next round, et cetera, et cetera. So, and then the other question for us is, does the check size that we think they actually can write fit to the fund structure they're deploying? Those are 2 things, sourcing and the amount of capital getting put to work, that we think we can understand really well. Taste is the hard one. We're investors typically in funds 1, fund 2, the earlier phases of these funds. The investors at these, maybe it's a solo GP, maybe it's a team, but they tend to have track records that are interesting, but not realized. They're early. And I think you can get signs of taste, but in reality, it's blurry. And we accept that and we do the work we can, but in reality, we know we're not going to be perfect there. So we want to really get sourcing. We want to really get right to win. And we just hope taste is there. But when you get all 3, things can get pretty magical. So that's sort of how we think about it.
I see that you've proudly stated that you are user-friendly LPs. What does that mean to you?
Yeah, I want to test this back on you too after I go through it. But I think there's 2 components to it. The fun sort of the cute one is we really want to be approachable. I'm wearing this T-shirt not because it shows the Gresham insignia, but we actually wear this to annual meetings. We wear this to a lot of meetings. Our goal is to be an approachable LP. When we come into offices, we get confused for if it's a venture capitalist. Sometimes people will think we're founders. If it's our private equity entities we invest with, they're like, who are these jokers coming into the office? It's all deliberate. The goal is to take things down a notch, make it more comfortable. We think it might help us win allocation at the end of the day in some cases because people think we're friendlier. I think we try to we ask good questions. We do real work. We don't do make work. So we just try to make things, very useful to us, useful to the people on the other side of the table, and generally make it lighter than a typical LP. That's one component of it. The other piece is leaving a great taste in everyone's mouth in every situation we have. So that means both managers in the book, managers that aren't in the book. We want everyone, even when we turn them down, to say, you know what, like Gresham didn't give us what we wanted to hear, but at least they were straight, they were honest. So what that means is we have very strong filters. We know what we want in a manager. Back to the last question. If someone misses the filter, we typically know maybe 10 minutes in the call, but certainly within a few days, we're going to let that person know that, hey, this isn't a fit. These are the reasons.
Yeah.
But, love to talk down the road if things change. The cool thing is you get a bit of a flywheel benefit because if you leave a great taste in that person's mouth and they understand what you like, they actually send you deal flow. So one of our hacks is some of our best deal flow comes from turndowns we've made just because people know what we actually like. So I think you put all that together and, being honest, transparent, easy to work with, and then more approachable, we think it's helpful. I'm curious to get both of your perspectives. You're both in the business. Like, does that sound unique at all? Or maybe everyone's doing it and we're confusing ourselves.
I don't think people are wearing a big sign on their back that says pitch me. I think that's different. I think the fact that you're showing up to events wearing the Gresham shirt is actually quite different. Otherwise, people are sort of like, we'll come find you. We'd rather you not find us.
Yeah, I think you're starting to see a bifurcation when it comes to allocators. Part of it is, um, you know, where they are in their kind of the maturity as far as, and I don't use that as a term of like, they're smarter or wiser. Just they've been around longer, um, versus kind of a new crop of allocators, and it might also be sliced into generational changes as well. I think
Yeah.
those who, read from, as I've heard other allocators call it, the Bible of David,
Yep.
right? Um, there are some like still like that's all they follow, as well as, and there's another group of kind of like zealots, I guess, if I'm using the same terminology, or analogy, that are trying to go around it a different approach. I think as a venture capitalist and a GP and a future kind of fund manager, I want to bring together a mix of folks who are really thinking about how do we be successful in these next 20, 30 years and not just rely on what we've done in the past. And so I am looking for value added allocators.
Are
Makes sense.
you actively vetting managers right now?
Always, always. One of the things we try to implore on people, especially on the manager side, we're always open for business because a lot of times our deal flow is not about now. We're building pipelines that go into effect 25, 26, maybe even 27. One thing I've learned in this business, it is very long and sometimes timing doesn't work. And one thing we're a little bit unique on, we don't love toehold positions. If we're going to get severely cut back on a commitment, a lot of times we'll say, you know what, it's okay, not the right time, but let's just stay in touch. So we build relationships between cycles. So yeah, we are always open for business. It just doesn't mean we're thinking about now. Sometimes it's a future decision.
I see we jumped into it because of my questioning with the conviction, kind of jumped right into it. But could you give us the overview of Gresham and kind of how it came to be?
Yeah, absolutely. So Gresham, you nailed the entry there. About 9 billion across 120 odd families. Really, what you can think of it is financial quarterback, maybe just sort of white glove approach across asset management, wealth management, estate planning, you name it. We just try to make the lives of our clients easier, and at the same time, we want to build fantastic endowment like portfolios. And that's really what our team was brought in on the investment side to do. A lot of our clients be first generation wealth creators that sold a business, that may have sold to our private equity funds, for example. They might be GPs themselves. I think what we try to do is work with people that really understand investing and want a portfolio that on the surface feels risky, in the sense that you're doing venture capital, you're backing smaller funds, but when you put it all together, that balance and diversification creates a really powerful flywheel for return and really reducing risk. And I think that's the beauty of our model. It's self-reinforcing. People come in for the financial quarterback approach. It keeps them there and allows us to invest very long-term, much akin to an endowment. Myself, cover the private portfolio. For us, that's as low as a $15 million solo GP all the way across to an oil and gas fund and everything in between.
Wow.
The piece that might connect every bit of that is we do tend to play on the smaller side of things. That would be true both in venture and buyouts, even oil and gas. And we very much tend to work with people early in their life cycle. And the goal is to partner for a long time. We're a small team. We have 4 folks. So we're hoping to get 2, 3, 4, maybe 5, 6, 7 funds with people when things really line up. And that's the way we enter relationships, is really trying to build a partnership.
And how did you come to that strategy? What's the sort of thought process on focusing on those? It's like sub 25 million.
Well, we will do sub 25 million.
Got it.
I think where we got there, look, the goal is always how do we create the most alpha while taking the right amount of risk? Like at the highest level, that is the goal. And we've looked at the environment over the last really 10 years. And look, a lot of capital has came into spaces like venture capital. We all know it. And I also think there's a different way people win deals maybe than it was 20 years ago, where you don't have to be part of a large branded firm to be successful. You can have a brand yourself. And I think even the bigger firms tend to be, a handful of people might be driving a lot of the best results of those firms and have sort of the halo that makes the overall business great. Sort of we said, maybe we can find people who are focused more on the pre-seed side of the equation. but have the same really interesting halos that would also work in a big branded fund. If we put those two things together, maybe we can create some interesting and exciting deal flow. The rub is these are smaller funds and we're still a pretty big ticket. So we certainly have to undersize an allocation with a $15 million fund, so to speak, relative to maybe the classic venture fund you'd invest in as an LP. There's a lot of work that comes with that, but honestly, we have fun doing it. I think there's a bit of a flywheel around, as an LP, when you have a lot of great, smart GPs around you, they're your best source of deal flow in some ways. So having a few more takes more work, but it also means our pipeline fills faster. So I think you put it all together. We think we're getting the right risk doing that, but we accept there are some risks you take as a solo GP that you may not get at a larger multi-stage. It's all relative, so to speak.
Are there any macro trends that are influencing your venture strategy as we speak?
Yeah, I think I just alluded to one, which would be the capital influx that has gotten us smaller earlier. The other one that makes us nervous and changes our return goals is the exit environment. And I think we all know it, but it feels unlikely we're going to see the big time M&A deal, the $5 billion plus mega cap tech company buying out, you name the startup. That just feels tough for regulatory reasons. I hope we're wrong, but we're sort of expecting to see fewer of those. That's one. And it's just unclear on the public markets. We think that'll turn back on, but we don't know what the valuation environment's going to be. And when you put together sort of lack of M&A, a valuation environment that we're just not certain about, what that means to me is longer holding periods potentially. And for us to get compensated, we need higher MOICs, all right, higher multiples. Mm-hmm. So I think the bar for us has forced us to go even earlier and lower valuation, so to speak, trying to make up the MOIC. That way our IRRs work. The problem is you move one piece of it, the other side moves two. You go earlier, you're holding even longer, which we do recognize. But that's probably the biggest trend on our mind. I mean, look, venture is an asset of consistency. So it's not like we're going to pick our spots year to year, but we are evolving the types of managers we seek because of that environment.
Yeah, to that point, Sean, I heard from a early stage investor who was talking to someone who was at a mega fund and trying to convince this mega fund to kind of look at their good deal. And they were saying, "Oh, look, it's good, but if something doesn't have clear sight to $5 billion exit, then it's not interesting." And so that's a huge gap from the days of hey, it needs to at least get to $1 billion unicorn. And so if everything between 500 million to 4.99 billion is just not a venture backable company to a large amount of the dollars in venture, that seems like an arbitrage right there.
That's our view. And look, we're excited by the secondary liquidity that's helping solve it, but that may be only in that's the halo companies that have that. So, we're trying to be nimble, but we agree. We think there's an opportunity being small. So that's where we've put our capital.
Interesting. And I saw you had a tweet about opportunity funds a bit back. Does that play into the strategy or have you not seen any lately? Is this just out of vogue?
We hear about them. People ask us about them. I mean, this is one place where I think we do have a fairly firm view. We're not believers in the opportunity fund concept. And I think the reason why is somewhat straightforward. If we're backing someone who we believe is great at pre-seed and seed investing, that is a certain skill set. The hard part for us is to expect that same person to also be great at later stage investing. And I know there'll be a few people in the world that could do both exceptionally well, but it's a little bit of life's too short to think that we're going to be the one that identifies that person. So we sort of put our hands up and said no mas. That's going to mean a few deals that we probably can't do, and that's okay. We don't need to be in every great deal. But we are sort of holding the line on opportunity funds that they're just hard to be successful at. I think there's a reason why some of the great multi-stage firms have different teams, and we respect those groups, so we tend to believe them.
With the structure of Gresham, have you guys how much influence does each family have on kind of what type of venture portfolio they're seeking? Do they already have ideas? Are they open?
It is an excellent question. I think this is where we differentiate from a lot of wealth managers. Pros and cons to this answer. Because we have families that truly have views that would cross any spectrum you possibly pick. With 120 families, you have every view in your portfolio, so to speak. It actually gives us the ability to take none of those views. I mean, look, we collectively listen, but I do think we have the luxury of recognizing no matter what, something we do might, if someone's on the left side and someone's on the right, you're not going to make both happy in certain deals. It means we can actually invest directly for them. I mean, they're with Gresham to get fantastic investment results at the right level of risk. I think it lets us be very honest and true to that because we don't have to buy into one person's particular view. Mm-hmm. So, and this is why I said it's a pro and a con. If someone comes to Gresham and they want to pick the managers they invest in, we're going to politely let them know that we're not the right fit for them. Because if we want to be competitive with the very, very best VCs, and you both will understand this, we can't come to said VC and let them know that we have 120 separate subdocs that need to invest. That's not tenable for really any GP. Certainly not the best. We need to come with a single pool of capital, a single check where we can speak to that money. It needs to be pre-raised. We need to be able to give them very clear timelines of when we'll be done by and back it up and be ready by then. That forces us to build pools of capital where our clients invest into. It makes it very friendly for people on the GP side of the equation. I think it makes it very easy for our clients, but for the ones that do want to make individual decisions, we just may not be the right fit for them.
Yeah. What's that look like from a sort of structure and operation standpoint? Are these individual funds that you're funding with different LPs annually, or?
Yep. There's two ways to go about it. There'll be a few groups that run the evergreen structure, pros and cons to it. We've gone down what looks like an SPV, maybe you almost think as a fund to fund, but every couple of years we go to our clients, raise the entire pool of capital before a dollar gets put to work. And then we deploy that money over the next couple of years, essentially. The beauty for us on the investment staff is we know what our budget looks like before writing the commitments, so we can size the positions correctly. We can come to GPs and let them know that the money's ready. The beauty is it comes from our clients, so it's not really a fundraising exercise. It's really asset allocation. Each of them have their own liquidity models that suggest maybe you commit, a few $1 million, the next person might be 10, et cetera. So it's built ground up by their particular asset allocation goals. We just have the luxury and privilege to deploy it.
No, I think it's been a big question mark for wealth managers and RIAs on how do we do this? And do you have any thoughts on sort of like why basically like why this has worked well from a client standpoint too? Like what are the clients liking it? Is it working for them?
I think the clients that have been with us for more than 5 years love it. It's very clean. The model that we deploy is very clean. An evergreen structure can get a little messier at times. The one nuance of our approach is there's a lot of paperwork. You have to have a phenomenal back office team because every couple of years is a new pool of capital. There's a whole bunch of K1s that come along with it. So there's a lot of process in between us making a commitment and our clients on the other side. That's what Gresham does exceptionally well. But the beauty of it is, I think every client can get their own distinct pool of capital. There's no intermingling. They own a percentage of the vehicle they're in. They could change every couple of years if circumstance changes. Like maybe they sold another piece of their asset or their business. They can deploy more money. That's the positive. The rub would be is it does take time. Our model, if you start with us today, we let clients know it might be 8 years until you can really think of this as a mature private equity portfolio. Whereas an evergreen structure, you could invest $1 tomorrow and you're fully invested. We like our approach. I think as the investment team, I came out of the classic foundation. This feels very similar to investing like an E&F. That's the model that, I like to think I grew up in, and it feels very similar. But I think the clients that have stayed with us come to appreciate it as well.
Now we're going to take a quick break to speak with our sponsor. And on the show today, we have industry expert and sponsor, Braughm Ricke, founder and CEO of Aduro Advisors, which leverages best-in-class technology powered by the industry's top professionals to provide premier fund accounting services. Thank you, Braughm, for partnering on the show. Well, putting your kind of true hat, ventures hat back on, and all the things you've learned from that point on, curious on best practices for emerging managers. Like, what advice would you give them in terms of setting up their first or second fund? And are there any pitfalls they should be particularly cautious about?
Yeah, I think that, leveraging service providers, such as fund administrators, lawyers, banks to a certain extent, going full, on, having your fund audited, et cetera. I think those are all good, important things to put into place from the get-go. Yes, they might be a little bit more expensive from a, cost load perspective for fund one versus when you're on funds 2 or 3, but really establishing those, good hygiene, I guess, right, from day one. And really also thinking through what path you want to take your firm on. And what I mean by that is, is this a, multi-generational, multi-partner, kind of platform that you want to build out? Or is this, I have, 15 years left to do investing, and this is going to be the structure, and this is what I'm going to do. And then once I'm done, I'm done, right? Yeah. And so once I'm done, the firm is done, right? Yeah. And so kind of establishing which course you want to take your firm on from the get-go. That can change over time, absolutely. But I think that having a good understanding and a good idea of that. I mean, when you look at like Foundry Group, right? So somebody that we know really well because they're here, close to where I live. They knew from what they post back in 2007, 2017 or something like that like once we're done, right?
Yeah. So. Yeah, it's key to have it. I used to think of it as like, are you the Rolling Stones or are you a kind of like the LA Lakers, right? You're going to keep going. You're going to wait till somebody else is trained somebody and take the talent.
Right.
Or is it like, this is the band and when we're done, we're done. Now that's good to, I think most people think that emerging managers, that line of thinking only applies to kind of like the narrative and vision that you tell in allocators, but it also influences so many other parts of your business too, right?
It informs how you build your business and how you structure it from a, staffing, who you hire. Are you hiring associates and growing them into partners? How many partners are you having in? I think it instructs a lot about, kind of how you build your business from the outset.
Yeah. So we've seen also kind of something that they should think about is this operational outsourcing. Like we've seen an uptick on piecemealing different parts of your back office, even if it's within the same kind of arena of fund management. What functions do you see are most commonly outsourced today, and how do you assess the risk and benefits of like getting it from different people or just getting it most of them functions from one group?
Sure. Yeah, I think that the more you can rely on one group, the better, right? Because everybody has a finite amount of time to manage all of these different relationships. Looking at our client base, we have 600 some odd clients. About probably 80% rely on us for their management company work, which is effectively their operating entity. And I know that's the entity that's paying the bills, paying the rent, paying the salaries, et cetera. And, they're looking to us for, everything from what payroll service to use, accounting platforms, expense management platforms, et cetera. They're looking for us for advice and answers there.
I know that data is really important for you and your team. I was curious, has Aduro conducted any recent research or published any insights on fund operations or just general kind of LP or VC trends?
Yeah, so we've been, again, leveraging our ability to utilize our core technology stack and our core technology platform to look at our data. So nothing from a, kind of research on fund operations specifically, but more looking at, of course, benchmarks, net IRR, gross IRR, TVPI, DPI, breaking that out by sector, by stage, by fund size, by vintage, for the benefit of our clients, which is something that we're starting to provide back to our clients on a regular basis. We have our next report coming up next month. So really focused on how can we leverage our data for the benefit of our clients, but then also starting to look at, market trends. How many of our clients are actually doing distributions? I think in the first half of the year, we had something like 130 or 140, individual distributions occur in the first half of 2024, which that's probably a little bit contrary to
I was
a
going
lot
to
of the
say
market
that's
data
headlines
out there, right? And so, and there's a lot of smaller ones, but they are kind of adding up from a DPI standpoint over time. And so looking at that for the benefit of our clients, and also thinking through, how can we be at the forefront of providing that to the marketplace as well, and kind of looking at, ways that we can be a thought leader in, the broader marketplace, not just for the benefit of our clients.
Yeah. On the reverse of that, have you seen, you're providing the insights and data. Have you seen your clients use that to make better decisions from an operational perspective?
Yeah, I think so. They've used it from, a lot of times benchmarking themselves, right? Not just against the hard and fast, or, the quantitative net IRR, where do I fall within this specific vintage year, but thinking through, okay, I've, did a distribution this year. Where does that kind of stack me up against the other, 600 clients or whatever it is? And so I think that utilizing that data much more from a comparison standpoint for themselves is helpful. And thinking through what are other managers doing? Okay, I've got a realization coming up. Are other managers focused on getting that out the door, getting that back into LP's hands, or are they focused more on recycling and thinking about how can we reinvest that into the portfolio for better returns down the road, right? And so where is that focus right now? Where should I be focusing? What do LPs want?
If you are a GP or LP looking for fund administration, please go to aduroadvisors.com. And now back to our LP interview. With that structure, is there anything unique for our GPs that going through a process with Gresham they should know about?
That's a great question. I spent a ton of time on the process piece before I went on a vacation, right before I joined, and really sort of put myself in a corner and said, okay, let's think about how do we continue investing as well as we were at DuPont at a new entity, and maybe how can we even do it better in some ways? And I think process was a place where I saw an opportunity, and I worked with Ted, I worked with Joe on my team. Collectively, the three of us are the investment committee. So Ted's the CIO, Joe would be my counterpart on Publix, and myself. We are the 3-person investment committee, all investors on the team. We run a lean process on people. And the beauty of that, and what I realized, is we could take that on the other side and work with GPs much more transparently than they're used to. And, I think a lot of the larger institutions, the more established groups over time have built great processes, but they tend to have more steps and they tend to be more opaque. And there's just less control for the decision makers, the people actually in the investing seats at those entities. That's an advantage for people like us at Gresham, to where we can just be quicker. It doesn't mean we don't do our work. Back to the building pipelines. We meet people early. We do our work ahead of time. It means we can actually give a commitment baked and ready and worked and diligence fully to people that aren't even raising money yet. And that's allowed us to be a lot more successful, in my opinion, on the allocation side. So I think the process we have has us doing the same work. We just do it ahead of time. And I like to think the certainty we can provide GPs around timing is going to be helpful and hopefully win the day on allocation. And in our experience thus far, it has.
What I'm hearing, Sean, is that first deal you ran on and how that had such an impact on you. And you're just saying, hey, we need to have a process that anybody is able to do this to take advantage of the market.
That's exactly right, Ernest. That was a big learning for me, that you still have to do your work. So I don't want to make light of the diligence. There are steps you have to take as an LP. The question is, when do you do them? You don't have to fit within the GP's actual process. Most times you let someone know, hey, we'd love to do work a little bit early. That way we act more like a re-up. Frankly, we're going to act more like someone that's even ahead of the re-ups. They love it. That makes it easier for them. They just have less people doing references. You think about if you're a GP and you have a CEO who has to do 15 references across 2 months, that's painful. If we can do that work 6 months early, it's just easier for everybody, and it positions us really well. So that's exactly right, Ernest. That learning I had in that first deal has really formed where I am today. And I think it's allowed us to build a great book and win the allocations we need.
That's in contrast to plenty of people I think get frustrated when they find out, oh, you're actually not raising right now. Why are we chatting? um, Interesting. Is there anything in particular you're looking for? It's great to know. It's like, it's cool if you're not even in fundraising mode, 6 months, 12 months early. Anything else in particular that you're on the hunt for right now?
Yeah, it's maybe at first a high level comment, then I'll go to the detailed piece of it. I do think LPs today need to be nimbler. I think the markets have institutionalized, like buyouts is institutionalized, and I actually think the market's better. I think buyouts have improved through institutionalization. Venture feels in that process. There's just more capital chasing. It actually could be a good thing, but I think what it means as an LP, you just have to be nimble. Things that may have worked for 30 years may need to be evolved. So at one level, I think we want to be nimbler today as an LP. What that's played out towards, I think we've all experienced the sectorization. I'm making a word up here, but the sectorization of venture capital, where GPs have gotten even more focused on very specific pieces of the ecosystem. They've tended to be around B2B, SaaS. And look, we love B2B. We love sector-focused funds. We've done a ton. We'll continue to do a ton. We'll still do a lot of enterprise. But we did look at our portfolio and say, wow, we have a lot of sector focus. We have a lot of enterprise. Where are the generalists? Where's the consumer in our portfolio? And that did make us step back. And again, we're not changing. This isn't a full turn. We will continue to do a lot of the same. But we did say, there is a place for generalists in this world. So we tried to think more thoughtfully about that. We have looked around the consumer space saying maybe we need to do a little bit consumer, and I mean software consumer, not product consumer. So I think that's probably the biggest sort of shift thing we're looking for. But at the end of the day, like I go back to that point around what we look for in general. Edge is always the key. So I think if we found someone that's doing a sector-focused B2B SaaS fund tomorrow that had extreme edge there, we would do it. So I don't want to take away from that. It's not a change, it's just an adaptation, maybe the way to think about it for us.
And any pet peeves or anonymous stories of what not to do?
And this isn't, I don't really put this in the fault of the GP, but I think a lot of times LPs, and it goes back to the process question, but I think LPs are forced to speak ambiguously a lot. And I think sometimes there's just a language misunderstanding between an LP and a GP, and GPs can be like, oh, if I just talk to this person every 2 weeks, it's going to make a difference. I could tell you as an LP who looks at a lot of funds, like we're bombarded with stuff. And I think the way and this won't be true for everyone. That's the problem, is we're all different, right? Like you met one LP, you've met sort of one LP. But I think in our case, like if we're working, we're going to let someone know, hey, we're going to spend the next month thinking really heavily about you. But we'll also tell them we're not working. The problem is if someone tells someone, hey, we're not working, we're busy for the next 3 months, and they keep bugging us, we actually meant what we said. What I try to remember though is sometimes other LPs might respond to it. So we just try to step back and say, we get it. Like there's a bit of miscommunication, but I think that's the one, is trying to actually read between the lines of what an LP is saying. I recognize the difficulty in that, but I think overtouching can actually be a negative at times too. So I'd say the right cadence is important. It's like dating. I tell my team this all the time. The GP LP interaction is almost like dating in high school, if that makes sense. Like you have to have the right balance of communication. And if it gets oversided from the LP or the GP, it can really create a sort of a bad situation. So we try to think about that a little bit.
You don't want like 6, 7, 8, 9, 10 unread texts or unresponded texts.
Yeah, exactly. I would translate it into like an email number, but I think there is truth to that, right? When we're fighting for allocation, like if I email that GP like 6 times in a week, like we just seem desperate, right? Obviously. So it's sort of thoughtful. You want to do like a thoughtful catch up. I think the same goes for a GP trying to woo an LP. I think there's a thoughtful amount of communication, and overdoing it probably puts one in a weaker position at times.
Yeah, absolutely.
I just read this book called Super Communicators, and it was speaking about just like the intentionality and how like to, if you're on the same kind of wavelength, how our brains start to just kind of mimic each other when it's intentional and genuine. And so many times it feels like in our world of GP, LP, interactions, it's so forced and not real. And you have to remember, it's like any other relationship you're developing.
Exactly. We're just humans at the end of the day, and that's where I think that approachability and yeah, I got to read that book, Ernest. That sounds like a good. Back to the book question. I think that's when we should probably table.
The Swimming with Allocators reading list.
Yeah, I have quite a large one now. So Sean, I wanted to ask also kind of a reverse question. What do you think GPs should be looking for when they're building their LP base? Like if they have a choice of like all like people are sending them tons of emails, right, to get in. What do you think they should be considering?
Yeah, I love this question. We do get to answer this one from time to time. I think there's the recommendation for us, the GPs, is one, smaller is probably better to a point. And I think sort of 10 to 15 feels like a really good number of LPs. If I were a GP, that's a very manageable number. You wouldn't want any one of those singular GPs to be too much of the capital. So, maybe your anchor's 15%. I think folks getting 20, 25, 30 can be a problem. I think the issue that GPs need to think about is twofold. One, the pack herd mentality of the people on the other side of the table. So let's say that you have one LP who anchored you, and that same LP is going to bring you another, 50% of your capital base. That will sound great. Like, boom, easy button, you're raised. And you would be. That fund will raise very quickly. The problem is, what if that first LP has a problem by your next fund? What does one thing's going to happen to the other 50% of capital? That to me is a real risk. So if I'm a GP, you want to diversify both by number of names and both where those names came from and how those people think. Groupthink is a problem for LPs. It's a problem for everyone in different ways. And I think LPs have it around commitments as well. Think about that. And two, I think a question I would always have if I'm a GP is trying to understand who is your deal champion and whether they're going to stay at the institution. Because a lot of times, you may have a deal champion who is sort of on this path to grow and change. And the thing that's not discussed a lot is our industry does have a fair bit of shifting around in seats. And the problem is when you inherit a book as an LP, you don't have that relationship. So we always come to the table, and when people deal with us, you'll have myself and Irene. You might have myself and Maria. You may have Irene and Maria. There'll always be two people that you had a ton of contact with. And it is very intentional and deliberate because we want it to be in a world where, and look, we're not going anywhere, but we want the GP to feel comfortable that there were multiple touch points. We always have our CIO even sometimes after the commitment. We're like, hey, come have dinner with us, just so we have that. That's what I would do if I were a GP is you want to know a few people, a few decision makers, and diversify would be the two main points.
And how do you like to work with other LPs? What's that community like?
Yeah, it's awesome. I think the LP, like the thing you don't know coming into this industry is just how cool the community is. And maybe a little bit of color. Like one of the reasons it's so much fun is there's not that many people that do it. And there's even fewer who do it well. And you tend to be in a lot of the same managers. So you bump into these people all around the world. And that's the other part that's cool. Is sometimes you'll be in China, for example, and you'll have a weekend where you're just hanging out. So you really get to know people. And I think the thing that, LPs chat. So as an LP, what I like to think about it as you have different generations of your network. And when you're in your sort of late 20s, early 30s, the goal is to build it. And at that point, you're just going to add as many people as you can. And you're just trying to source managers. I think a lot of LPs make the mistake of at that age and that range of using the network to build conviction. I think conviction has to be built internally, one. And two, if it is a really good manager, you just told 10 other people, probably not the smartest thing in the world. But what comes out of that phase, though, is you find a ton of deals and you track them down. You figure out how to build conviction. And then you actually, a handful of years later, you probably have your ride or die group, your 3 to 5 people who you really have trust with. And now you can really talk deals and you can talk things that you love. These are the people you pull in on that hot deal that you happen to find where there's an extra, $10, $20 million check available. I think most LPs sort of have that general view. I mean, you look at our team, we have a 4-person team. We do a lot. One of the reasons we can is we think of that network as an extension of team. And it really plays a huge role in the sourcing side of what we do. So literally before this call, I had 2 30-minute sessions with other great LPs just chatting deals. And that's just the way the business sort of works.
So, getting your crystal ball, what do you think the venture landscape will evolve to over the next 5 to 10 years?
Yeah, that's a hard one. We've talked about a couple of them. I think the exit communication part, that's the piece I think the biggest wild card. I think I would love to put it back on you two after this. I think that's where we're spending the most time, is trying to think of exits and how to generate returns. I think the biggest question in our mind is whether the valuation that people are pricing things at in the private world and how that translates into the public when that turns on is probably the biggest wild card out there right now. And who's to say? We hope it translates really well, because that means we all just do great. It's just unclear to us what the outcome there is. But the problem is, Ernest, it's tough. We don't really have a strong view of the market today. I mean, our North Star right now is just backing exceptionally good investors and trusting their judgment. Love to hear, what do you two think? Like, where do you think the market, like, if you have an exit view, I'd love to hear. That would be very helpful. I'll get my pencil out.
I think, it's still going to be a little cloudy for probably these next 2-3 years. But we're really going to see what people are made of. I think we're going to have an influx of more spin out funds.
Mhm.
And I think the opportunity is actually, we've had like the influx, as you mentioned, Sean, of verticalized funds, but I think we're going to have more generalist funds that are stage focused, right? And not trying to, like, basically the unbundling of the multi-stage fund. And I think that's because of what we've mentioned before of like, what is venture backable has changed so much and is so dependent on your fund size, to be quite honest. And so I think there's going to be an influx of those types of funds, whether it be, focused on A, focused on B, focused on C, something like that. In the meantime, we've got to figure out this pricing. There's going to be a lot of contractions and of funds and companies, especially since 2-3 years ago, we told everybody, just make it to 24 and we'll be fine. So
Yep.
we got a lot of stuff to figure out.
There has been an interesting argument for, when I say consumer, I generally mean consumer tech as well, but the consumer brand investors that I speak with regularly, they do feel like they're able to focus on liquidity, and there's less mystery around the M&A market in consumer packaged goods, and that's part of their pitch right now, that it's not, you're not reliant on 7 giant companies. We're not sitting back waiting for the FTC to figure out what their rules are, that there's a lot more landing opportunities for those kind of businesses if they're priced correctly. So that's one thing I've seen in terms of arguments of like where to put your capital now, that there's actually some liquidity because there's some M&A.
Very interesting. That makes sense. There wouldn't be regulatory concerns about selling a great makeup product, I would imagine, the same way that might be for AI.
Exactly. Yep.
It just hit me, Sean, that we've been going about, I guess, 41 minutes here and no one's mentioned AI. I think contractually we're obligated to say something about AI. Any thoughts on it?
Yeah, right. That's good job, by the way. Awesome job that we were able to manage that for 40 minutes. I mean, our view, look, we think it's amazing. I actually think it's going to make a really big positive impact across our private equity book in total. I think our buyout book in particular will be the huge beneficiary of a lot of the great work that startups are doing today around improved efficiency. So we think it actually spans a lot of what we do. In terms of the venture book, like every LP, we have our folks doing the AI rounds. I think we're a little bit less excited about the extremely high valued rounds. They might work great. It's just tougher for us to understand that valuation question of, if someone needs a $20 billion type outcome to make the math work, it doesn't really, the venture outcome feels tougher to reach. So we're sort of looking for people that might be uncovering something a little around the margin that has AI, but isn't like a core foundational model that someone's chasing. That said, look, we have some dedicated funds in the space. Like we're like, just like every other LP who's chasing it, we've got our bets. So we're excited about it, but we do think some of the prices are a little scary.
And any final thoughts or words of wisdom, maybe for the family offices who would be potential clients or GPs?
Yeah, I mean, I think final thoughts is we're open for business, folks. Both family offices that need help. I think if someone's looking to build a really great venture portfolio, it's a place where you need help. This is a tough space. You folks know it really well, and I think there aren't that many LPs who do it well, and I think we have that. And as a GP, just reach out. I was being very serious. We try to respond to essentially every email, even the ones where they're like a random hedge fund doing something so far outside of my space. I still type no interest on response. But all kidding aside, like we will have a response. We hear things out, but when we say we're not interested, we mean it. We have strong filters. So just trust us on that. We'll let you know if we're excited. People will find out.
Well, thanks, Sean, for all the insights
Absolutely.
and great stories. If anybody wants to reach you, how should they reach you? They can easily find you.
LinkedIn, I've got a goofy smile picture on there. Sean Warrington, easy enough to find. Send me a message. I'll respond.
Awesome. Thanks, Sean.
Thanks, Sean.
Take care, everybody.
See you later, allocator.
After Portfolio Tile, investing with a smile.